Economics studies how societies allocate scarce resources to produce goods and services and distribute them among individuals. Key concepts in this field include supply and demand, inflation, and economic cycles. Grasping these principles is essential for informed decision-making in personal finance and policy. Supply and demand, the law of demand. The law of demand states that, all else being equal, as the price of a good decreases, the quantity demanded increases, and vice versa. This inverse relationship is depicted by a downward-sloping demand curve. Determinants of demand, price of the good, primary factor influencing demand. Income of consumers, higher income increases demand for normal goods. Prices of related goods, demand is affected by prices of substitutes and complements. Consumer preferences, changes in tastes impact demand. Expectations, future price expectations can influence current demand. The law of supply. The law of supply states that, all else being equal, as the price of a good increases, the quantity supplied increases, and vice versa. This direct relationship is shown by an upward-sloping supply curve. Determinants of supply, price of the good, direct influence on quantity supplied. Production costs, higher costs reduce supply. Technology, technological advances increase supply. Number of suppliers, more suppliers increase market supply. Expectations, future price expectations can affect current supply. Market equilibrium. Market equilibrium is where supply equals demand, preventing surplus or shortage. Equilibrium price and quantity change with shifts in supply and demand curves due to various factors. Applications. Understanding supply and demand helps in pricing strategies, market predictions, and policy making to stabilize markets. Inflation. Definition and measurement. Inflation is the rate at which the general price level of goods and services rises, reducing purchasing power. It is measured by indices like the Consumer Price Index (CPI). Causes of inflation. Demand pull inflation. Excess demand oversupply. Cost push inflation. Increased production costs. Built-in inflation. Wage price spirals due to inflation expectations. Monetary inflation. Excessive money supply growth. Effects of inflation. Erosion of purchasing power. Reduced money value. Redistribution of income. Benefits borrowers, harms savers. Uncertainty. Discourages investment. Menu costs. Costs of updating prices. Controlling inflation. Monetary policy. Central banks control money supply. Fiscal policy. Government spending and taxation. Supply-side policies. Improve productivity to reduce costs. Economic cycles. Definition. Economic cycles are fluctuations in economic activity with periods of expansion growth and contraction recession. Phases. Expansion. Increasing economic activity and employment. Peak. Maximum economic activity before downturn. Contraction. Decreasing economic activity and rising unemployment. Trough. Lowest economic activity before recovery. Causes. External shocks. Natural disasters, wars. Monetary and fiscal policy. Influence of interest rates and government spending. Confidence levels. Consumer and business confidence impacts spending and investment. Inventory adjustments. Business decisions on inventory levels. Measuring and managing cycles. Indicators like GDP, employment rates, and consumer spending measure cycles. Governments and central banks use counter-cyclical policies and stabilization measures to manage economic fluctuations. Historical examples: the Great Depression, severe worldwide downturn in the 1930s, post-war boom, rapid growth after World War II, global financial crisis to 07-09, major recession triggered by housing market collapse. Conclusion: understanding supply and demand, inflation, and economic cycles is crucial for personal and policy decisions. These principles determine market dynamics, influence purchasing power, and guide economic stability efforts.